What's up, guys? Welcome back to the podcast. This is episode number 6, and we've got a hot topic, a topic of interest, one would say. We've got a special guest today, and we're talking everything, mortgages, interest rates, you name it. Do you want to welcome our special guest, Ryan?
Yeah, absolutely. So, guys, today our special guest, he is a mortgage agent. He's in Toronto. He has over 14.9 thousand followers on TikTok. Woo! That is where I met him. He brings so much value, so make sure you stay tuned because we're going to be chatting to him very shortly. Let's roll the intro music.
Ew.
All right, so welcome back to the podcast, guys. We are here. It's episode 6 today, and we have another very special guest, as we mentioned earlier. So today we're looking at all things mortgages with my good friend Aubrey Borenstein. So hopefully I pronounced your last name right there, Aubrey, but welcome to the podcast.
Thanks, Ryan.
Welcome.
Thanks, Daniella. Like Ryan said, my name's Aubrey Borenstein. I'm a licensed mortgage agent with Dominion Lending Centers. Been a mortgage agent just over 2 years, and happy to be here.
Super pumped to have you here. I mean, when it comes to real estate agents can't do anything without the mortgage agents, right? I mean, unless it's a cash purchase. But other than that, how I view the mortgage industry is, we're married to each other. So I really love that partnership when I'm doing transactions. So it's a key component. And I think a lot of people need some information from mortgage agents on a day-to-day basis. So we're looking forward to see what you bring to the table today and answer some of our questions and whatnots.
Thanks so much, Danielle. Happy to be here. Yeah, I agree. It's a essential relationship that we have as mortgage agents and realtors in order to help our clients. So, couldn't have said it better myself.
Yeah, so Aubrey, when we talk about mortgages, a lot of people maybe think go straight to the bank. So what can you say to people about why they should use a broker or a mortgage agent versus going directly to the bank and just speaking to a mortgage advisor?
Great question. There's a few differences. A mortgage representative or specialist at the bank works for that particular bank. So they're employed to sell that bank's products. Whereas as a licensed mortgage agent, I have a direct relationship with that bank and over 50 other different lenders. My job is not to sell you one particular bank's product, but to help you get the best mortgage possible from a wide variety of different lenders. So there's no bias when it comes to a mortgage agent, whereas a mortgage specialist, they're sort of inclined to sell you on that particular bank.
I love that. And one thing that I've learned as well, because I used to host Realtor days when things were open, was that in the bank, even if you manage to find a mortgage agent, they're working like real estate agents, field workers. So when you go to the bank, even though a mortgage agent there will sell that particular product, it's really hard to find someone who specializes in mortgages, or else you're reaching a financial advisor in the bank, is what I've come to learn. So I always like to have that special contact because I know you guys work wherever you want as well. Like we know that you're in the Dominican right now. Lucky guy.
Absolutely. That's a very good point. And different hours as well. Like I work 7 days a week for my clients. If they want to put in an offer on a weekend or they're looking at one property and they call me, I'm always there. Whereas no, bad words against, a mortgage agent at a bank. I'm sure they're great. It's just a different level of service altogether. So, and there's no difference in terms of cost. If anything, you save money and you get a better rate when you use a licensed mortgage agent. So it's always a good idea to look at all your options and make a decision from there.
Yeah, definitely super important to be available for your clients, especially. I've heard horror stories of people who have used mortgage advisors at banks and they just haven't been able to get in touch with their person. And it's like, you're on a crunch, especially in this market right now. Like we need to know, do we qualify? Do we need, financing condition? We need that guidance from the mortgage person. And if they're not available, then, it's a struggle.
Absolutely. So with the recent updates of the Bank of Canada about a week and a half ago, they raised the prime rates, right? Can you chat about that?
So the Bank of Canada sets their two rates, basically, their overnight rate and their prime rate. They're both related to each other. And prime rates have a direct correlation to variable rates. So whenever you see a variable rate advertised by a bank, let's say 1.45%, it's really prime minus 1%, because prime right now is 2.45. So the Bank of Canada held their prime rate as is, but they do anticipate and they have foreshadowed that they're going to be raising it soon. So that can happen any day. They made a statement that it's going to be around March, but nobody really knows the exact date. But typically it's 0.25% at a time. It's, in my opinion, a lot more hype than actual substance when it comes to the actual effects of the rates rising. It will only affect variable rate mortgages, and it's 0.25%. So instead of getting a 1.35, you now get a 1.6. So your payment goes from roughly $2,500 to maybe $2,550. Over the course of a year, once they do it 3 or 4 times, then it can have a effect. But as of right now, it's not a huge deal. But yes, they do plan on raising it in March.
Awesome. Great update, Aubrey. And let us know as well, in addition to people who have been purchasing, have you been seeing a lot of refinances? What are you and who are you processing applications for the most right now?
Absolutely. I actually really love when people refinance, because it's people who want to take care of their future and build their wealth for them, their family. They're accessing the equity in their home in order to buy more assets. So when someone approaches me for a refinance, I'm always on board as long as it makes sense for their situation. I just helped an individual in Brampton, for example. They owned their residence for quite a few years, and they are in the process of refinancing, taking out some equity and buying another rental property. So it's definitely a common occurrence. Just especially where the market is the way it is. It's definitely tough to buy a property, but people in general do want to access the equity in their home and purchase. I think you said, who am I processing it with? Well, depends on the individual and their needs, but we can go to any of the big 5 banks. We can go to alternative lenders. It just depends on what the client is looking for.
And do you find that a lot of these refinances and purchases that you're dealing with in terms of a buyer pool, are they first-time home buyers? Are they investors? Who are you finding you're processing?
Typically, they're people who have owned home for quite some time. I do have a younger client who's more savvy, and that's just his main focus is buying real estate, and he buys one property, and just luckily over the past couple of years, because the market has appreciated so much, he's had the opportunity to refinance something that he bought 2 years ago and literally use that money as a down payment for a second property. That doesn't always happen, but in the market the way it is the past few years, it's given people the opportunity to do so. It's a combination of mainly people who have owned their property for quite some time and now are open to the idea. Rates are low. They realize they can access equity and buy a rental property. And once you break it down to them and you show them that taking on another mortgage doesn't mean they're going to have to go in their bank and pay it. If they get a tenant successfully, then it can cover the majority of the liability. So oftentimes when you break it down, they're more understanding and want to do it.
Yeah, and lots of renovations we're seeing as well. And like I can speak for myself, is that we just refinanced recently with you as well, Aubrey. So for us, it was like we bought just before the pandemic, and we saw like such good appreciation and interest rates being so low that we could then access a lot of equity in our home, cash it out, and do a full renovation on our home and still pay the same monthly payments. So like for us, that was a no-brainer, right?
Yeah, I want to respond to that as well, because a lot of clients ask me, Aubrey, if I'm refinancing and getting a larger mortgage, isn't my payment going to go up? The answer is most of the time, yes. But in some cases, if you're like Ryan and you had a certain interest rate and now rates are lower, even though you're increasing your mortgage balance, if the rate is low enough, then your actual payment can either be the same or sometimes even lower. So it really is dependent on the new rate that you're getting versus the old rate that you're getting out of.
And for us, I think we went from like a 2.79 and we are now on like a 1.9, and we changed to a 2-year fixed rate. So if we had gone with another 5-year fix, we probably could have got an even better deal.
Absolutely, yeah.
Cool. All right. So on the topic of first-time buyers, let's dive into that. What are your top tips for down payment? How do you save for a down payment? What are your options in terms of gifted down payments? You know, this is a big problem for a lot of first-time buyers coming into the market. They have no idea what's going on. What's your top tips for first-time buyers?
Good question. So everyone's different in terms of their financial situation, family members. I find out of the 3 things you need for a mortgage, which is credit, down payment and income. Down payment is usually the one that people don't have right away or they're in the process of sourcing. I find that a lot of first-time buyers do get help from family in terms of down payment. So if you're fortunate enough to have family members that are financially able and willing to help you with the down payment, then that's always a viable option. Whether you're a first-time buyer or not, you are allowed to receive a gift for your down payment. So that's number one. If that's not an option and you're saving, then simple things like creating a budget, identifying how much disposable income at the end of the month you actually have, and then working towards a specific goal, opening a TFSA or an investing account. And instead of just having your money sit there in your bank earning next to nothing, you can start investing and growing it at a faster rate. So those are some options in terms of down payment. And of course, as a home buyer, you do have the option to utilize things like a unsecured line of credit or a personal loan to help make up for any shortfall you have in terms of your down payment. Another option is that people don't always think of. Parents who own their own home can access the equity in their home to help you for a down payment. And there's different ways to structure it. You and your family members or your parents can actually be partners in real estate. So they aren't necessarily doing you a favor, but they're going to be benefiting with you. So they can help you with the down payment. You can come up with the mortgage payment, and you guys can be partners in that investment.
So would that be like a co-signer?
Yeah, it could be a co-signer or co-applicant. The actual percentage ownership is determined between the buyers. So some people do 99% them and 1% their dad. Some people do 50-50. It really is whatever you guys want. You can discuss that with your real estate lawyer on signing, and they sort of divvy up the ownership percentage. But as long as the family member is going on title, they can help you with co-signing, and they don't even have to go on title to help you with the down payment at all.
Gotcha. So what other sort of programs are there that first-time buyers can look at, like maybe the first-time home buyer incentive? A lot of people don't know the nitty-gritty of that. So can you dive into that a little bit?
Absolutely. So there's 2 or 3 main benefits when it comes to being a first-time buyer in Canada. The main one is, in Ontario at least, the land transfer tax rebate. So in Ontario, if you're buying a home, you have to pay a land transfer tax. Typically, it's about 1.5% of the purchase price. Now, if you're a first-time buyer, which means you've never owned property anywhere in the world or even co-signed on any property, you get a $4,000 credit on closing. If you're buying in Toronto, which has their own land transfer tax, you get another $44.75 credit on closing. The second main one is the home buyer's plan, which allows you to access money from your RSP without any tax implications, up to $35,000 per applicant. So if you're buying with your spouse, you can access a total of $70,000. It is a loan. You do have to pay it back. But if you have the majority of your money in your RSP, it's definitely a good resource to use. And then when it comes to what you mentioned, the first-time home buyer incentive, that's basically a shared equity program the government gives you or lends you between 5 or 10% in additional down payment. So don't get it twisted. You still have to come up with your own minimum down payment, but they give you an extra 5 or 10%. Ultimately, that will lower your mortgage payment slightly. There's no interest on that mortgage that they give you. You have to pay it back in either 25 years or when you sell the property, whichever comes first. But to be honest with you, it's not very practical. There are a lot of restrictions on that incentive. You cannot borrow more than 4.5 times your income. And most people who are buying a home do end up going to their max pre-approval, which is around 5 times their household income. So they often don't qualify.
Yep.
So out of all the home buyers I've helped, I haven't used the incentive once.
Wow.
Yeah, I find that as well. The banks will offer you like potentially cashbacks and things like that for first-time home buyers, or if you use that lender. I was offered it when I was getting a mortgage on my property, and honestly, my mortgage agent was like, don't even bother. If you take the lower rate or whatever this plan is, it's better for you. So there are incentives, just got to dive into them a little bit more and see if they're worth it or not for you in terms of leveraging how much capital you want to access.
Absolutely. I agree.
Awesome. Are there any other government programs, like there's RSPs, anything that lenders have for incentives that you're seeing now that could be advantageous to buyers?
Well, if you're a first-time buyer, from my experience, most of them are doing a high ratio insured mortgage, which is less than 20% down. So the amount of differences from lender to lender aren't huge. Like some lenders, for example, allow you to use 100% of your Canada Child benefit. And if you have 2, 3, or 4 kids, that can be a significant amount of money and can change your approval amount. But other than that, when it comes to first-time buyers, rates are lower for insured mortgages. For example, you can get a 5-year variable as low as 0.99, but once you put 20% down, it's a completely different rate. So from lender to lender, there's not too much incentive for first-time buyers. It's mainly the government programs like the rebates and the home buyers plan. But essentially, make sure you have the right professionals working with you, and they will guide you on the right path.
Question for you. I get this question asked a lot, and I always answer the same to my buyers. But if someone says, listen, guys, I don't have enough money to put down for 20%, would you advise someone to leverage the CMHC program or to wait and save up?
Absolutely. I would advise them to leverage the high ratio mortgage. That way they can buy the home with as little as 5% down. It depends on the purchase price, of course. If it's more than $1 million, you do have to put 20%. But if you're a first-time buyer and you're looking at properties under $1 million, the minimum down payment is going to be anywhere between 5 and 7%, depending on the purchase price. And yes, there is an insurance premium that you have to pay. It's a percentage of the mortgage balance. However, when you look at the cost of the insurance premium versus the benefit of buying now, the benefit is huge. Even if the market were to appreciate at 4 or 5% a year, the amount of capital appreciation and benefit that you're going to get by getting into the market now is going to outweigh that insurance premium tenfold, 20-fold. So definitely take advantage now if you can afford it.
Exactly. A lot of people can't save faster than inflation or faster than home prices are increasing. So I tell buyers the same. Buy now. You'll thank me at this rate every month when you see your property increase by $50,000.
Absolutely.
So, awesome stuff.
And one other point on that. Not only that, but if you put 5% down and you have that extra 10, 15%, you can use that money to do another investment or buy a rental property or invest in the stock market. So you have to be careful with leverage for sure, but there's different ways to utilize it. And there's always investment opportunities besides putting, the maximum down payment that you can afford.
Yeah. And you mentioned earlier before that when you look at mortgages, there's the 3 things. There's the income, there's the credit, and your down payment, right? So let's dive into the income side of things. A lot of people don't know what is the stress test. We saw it increase last year. What does that mean for people's purchasing power? Did you see a big difference in people's purchasing power, or, can you speak a little bit about that?
Absolutely. So a stress test is another word for the Bank of Canada qualifying rate. Now, what does that mean? Well, if you get a rate from a mortgage broker or from a bank, let's say 2%, for most lenders, you have to qualify for that mortgage as if the rate were 5.25%. So the reason that's in place is to protect you in case rates rise, to make sure you can afford it. So that Bank of Canada qualifying rate or stress test changes. As it goes up, the amount that you qualify for goes down. And as the rate goes down, the amount you qualify goes up. So yes, it does have an effect on your borrowing power. There are some lenders, mainly credit unions, for example, that are provincially regulated. They don't abide by the stress test. And let's say we got you a 5-year fixed mortgage at 3%, and your rate stays the same for those 5 years. You can actually qualify for the rate you're getting, meaning the amount you qualify for is actually true to the rate you're getting, which some people prefer. And ultimately, it just comes down to whether or not you can afford it. And if you can, some people like to take advantage of that lender or those types of lenders, and it's a potentially beneficial solution.
So basically, if you've got a client who is maybe not earning as much as, the stress test allows them to purchase a home in the area they're looking in, but they can go to a lender that maybe has a slightly higher interest rate, and they can qualify that way, you're saying?
Absolutely. And especially now, because the big 5 banks have raised their fixed rates, the interest rate is either the same or lower. I've had quite a few clients who come to me and they're in the process of buying a home, the bank denies them for what they want, and we take them to a credit union like Meridian or Duca, and we end up getting them approved for a lower rate at the mortgage amount that they actually wanted. And they're super thankful. So sometimes the rate is a little higher, sometimes the same, sometimes less. It's just the way they actually qualify is different, and it enables people to purchase sometimes the home that they want.
That's awesome. And question for you, I don't know if you know this or not, but do most people who take that route usually end up still paying less than renting?
It depends. When you include all the carrying costs like property tax, utilities, insurance, it's comparable for sure. It's not a huge difference. But usually it's within a few $100s per month between renting and, buying a home and paying mortgage. The financial difference, of course, as we know, is night and day between what you save, earn, and gain on your net worth statement every year. So for sure.
Yeah, I'd pay a couple $100 out of pocket any month to gain the equity that we're seeing in real estate. So
absolutely.
And I mean, rates is a hot topic. That's the first thing most people look at instead of the whole mortgage package, like anniversary dates, things like that. They just talk about rate. They ask you what's the highest, what's the lowest. So on the topic of that, in terms of variable and fixed, tell us a little bit about the pros and cons of each and kind of where you're seeing the best benefit right now.
Absolutely. And with that answer, I say this a lot, but it's true. It really does come down to personal preference. As you know, with the fixed rate mortgage, the rate stays the same, the payment stays the same throughout the duration of the mortgage term, which can be as little as 6 months or as high as 10 years. Some people prefer to, sleep every night knowing their payment's going to stay the same for a long period of time. Whereas variable, there is more risk involved. As the Bank of Canada can raise their rates, your payment can also increase as well. Over time, throughout the past 20, 30 years, variable rate mortgages have been cheaper than fixed rate mortgages. So over time, you're more likely to save money with variable. However, like I said, there are risks involved, and 1 year compared to the other, variable might be higher. There's no way to predict that from happening. So it really comes down to your personal level of risk tolerance. A second thing to consider is what we call break fees or mortgage flexibility. If you get a 5-year fixed and then you want to refinance 2 or 3 years in or any time in between before the mortgage has come up for renewal, you're going to pay a break penalty. That break penalty on a fixed rate mortgage is typically significantly higher than a variable rate mortgage. Basically, they use something called an interest rate differential. It's anywhere between 1% and 4% of your mortgage balance, which can be tens of thousands of dollars. Whereas with a variable rate mortgage, even if you break it the next day, like you get a mortgage, 5-year variable, you break it the next day, it's 3 months interest, which is a small price to pay to refinance your mortgage.
Yeah, I saw a lot of people wanting to break their mortgages, willing to pay $10,000 in fees just because the rates had gone down so much during COVID and it was kind of a wash for them. I don't know if you saw that too. But thanks so much for sharing that. And also, I think it's key to note too, if you go with a variable, you can also lock it in as a fixed, right?
Yes, for most lenders, you can go from a variable to their current fixed rate. Absolutely.
It's great to have that option, right?
Definitely.
Awesome. Are there any pros and cons to both or just kind of the risk tolerance, right? I guess it's also time of year.
Yeah, I would say main pros to a variable rate mortgage is your payment on average is going to be less. The interest is going to be less. Your flexibility is going to be higher. Con is your rate can go up at any time and you would have to be able to afford that increase. Pros with a fixed rate mortgage is your payment's fixed for the entire duration of the term. Con is on average, you're going to pay a little bit more in payment and interest over the course of the term.
Awesome. Thank you.
Absolutely.
Yeah, and we when we refinanced too, like we went from a 5-year fixed rate. We were only like just over a year and a half into it. We ended up having to pay, I think it was like $8,000 as a penalty, which, when you're pulling a lot of equity and appreciation out of your home, it didn't seem too bad, and it comes out of the refinance cash out. So that was okay for us. We accepted it, but at the same time, I wish I had known about variable rates when we first bought, because we could have avoided a bit of a chunk of a payment there. So
for sure.
Sweet. So let's dive in now a little bit into maybe the more investment side of things, but we want to talk about maybe some special products that you've kind of come across, or some interesting products that you've used to finance people who maybe had a rougher time qualifying for something. And what are some cool products that you use or you recommend to your clients?
Absolutely. That's a great question. And when it comes to products and for investment, I'm talking about rental properties. That's the main thing I focus on when it comes to investment properties. I don't do a lot of commercial or anything like that. So, for example, I'm not going to name any names, but I have a client. He's younger. He doesn't make that much income, maybe like around $45,000 a year. He was able to purchase his third rental property. How was he able to do that? Well, each bank, each lender values rental income differently. Most A lenders, most banks take about half of the market rent and they add that to your income. Whereas other lenders like Home Trust, ICICI Bank, Equitable Bank, they take up to 100% of the rental income, and instead of adding it to your income, they offset it against the mortgage payment, taxes, and heating. So if the rental income can cover the liability of that specific property, you don't have to use a lot of your own personal income to qualify. So it's a lot easier to actually qualify for a rental property than it is for an owner-occupied property. So in terms of the product, it's called a rental offset. Each lender is different. Some do 50%, some do 80, some do 100. And, most B lenders, for example, offer a higher rental offset. Yes, the rate is a little bit higher. You're going to pay 2.5%, 3% on the rate, maybe a fee here and there, but it allows you to purchase a property where you otherwise couldn't. So that extra few thousand that you might pay in interest is well worth it when you consider the property that you're going to be buying, the appreciation, and all the other benefits that come with owning an investment property. One piece I need to make clear on that is he did have the down payment available. So he had the 20% available on his first property. He refinanced, got the second, and then he partnered up on the third. So that's still something that people have to consider. But when it comes to qualifying, as long as they can find the down payment, typically for rental properties, it's much easier to qualify.
Amazing.
Other products that I want to talk about. When it comes to refinancing, there's two ways really that you can access the equity in your home. One is a standard mortgage refinance, which is basically you're getting a brand new, larger mortgage and you're taking out some equity. That's one option, which is typically a lower rate. The other option is a home equity line of credit, which is a secondary mortgage product. You leave your existing mortgage as is, right? And then you get a secondary HELOC, which is a revolving line of credit that you can access, pay down, access again. Really, people use a HELOC if their break fee on their current mortgage is substantial, like $10,000, $20,000, $30,000, and they can't afford to break it. Or some mortgages come with what's called a bona fide sales clause, which means you cannot break the mortgage unless you sell. So they're forced to get a HELOC. And others know that they're going to be paying that balance down pretty soon. So they don't care if they get a bit of a higher rate on their HELOC because they know within a month or two they're going to pay it off and there's not going to be much interest payable. So a HELOC versus a refinance, those are the two products you can use when accessing equity in your home to invest.
And what sort of difference in interest rates do you see with a HELOC versus a traditional refinance?
Great question. So when it comes to a HELOC, most people have a HELOC in second position. They have an existing mortgage. So when it comes to HELOCs in second position, the lowest rate that you're going to find is a variable for 4.7%, and the highest can go up to 9, 10, even 11%, depends on the loan to value and the actual credit score of the borrower. If you're getting a HELOC on a free and clear property, which is a first position mortgage, rates are as low as 2.5% for a HELOC from a regular bank. But most people who get HELOCs already have an existing mortgage. Whereas a refinance, same as regular rates. You can get a variable as low as 1.45, fixed in the high twos. So those are the difference in rates.
And for investors, because I deal with a lot of investors that are purchasing right now, they do make up a big buyer pool for me and what I see in the market. What are some smart ways for them to, and even other first-time home buyers who may be thinking about that next property, some smart ways for them to purchase and also utilize and leverage, I'm sure you know, but the BRRRR strategy and flips, construction loans, things like that, or even holding companies?
Absolutely. So the main step, whether you're looking to BRRRR and flip a property or buy a existing rental, the main step is sourcing your down payment. And if you have cash in your bank account and you want to use that, perfect, that's good. But if you're like most people and you want to access the equity or need to access the equity, you can take advantage of the refinance strategy that we just discussed, access the equity in your home. Once you have the 20% down payment available, then it comes down to the condition of the property you're buying. If you're buying a flip project and it's had a fire or there's significant damage or you got to change the roof, then you're not going to get a traditional institutional lender to lend on that property. It's going to be a private lender who doesn't care really about the condition as long as there's value there. And working with the right mortgage agent, we have access to private lenders, mortgage investment companies that finance flips all day. And when you're buying a flip, typically how it works is you come up with your down payment, you get a hard money loan from a private lender, you flip the project. If you're going to hold it, then we refinance you with a traditional A lender once your construction is actually complete. Now, if you're going to sell the property, then you sell it and you don't need a refinance. And if you're buying just a regular rental, then we can take you to any institutional lender.
Is there anything different when someone is purchasing through a holdings company or utilizing money in a corporation?
Yes, great question. So the amount of lenders that will lend on a property that's being purchased in a holding company are minimal. They're mostly B lenders, but the tax implications are night and day. I'm not an accountant, so best to speak to one in terms of the differences between the two. But yes, you can open a holding company and purchase real estate through that holding company. And if you are limited to B lenders anyway, then there's not going to be any difference. There are some banks on the A side that will lend in a holding company. It depends on the condition of the property. But yeah, great strategy to utilize and to speak with your accountant about the tax implications. And definitely we can arrange a mortgage for that purpose.
Fantastic.
So when we're out looking at homes, Aubrey, so say Daniella and myself, we've got clients, we're out there, we're looking at maybe vacation properties, we're looking at like cottage Airbnb properties. There's a lot of different little nuances to investment properties that perhaps we need to keep an eye out for, or that our clients need to keep an eye out for, like square footage, 3-season versus 4-season, whether the property is going to appraise or not. So what kind of things would you recommend are like high priorities to keep an eye out for when going in maybe without a financing condition? What risks are going to be involved with different things?
So when it comes to a conventional mortgage, which is 20% or more, most lenders want to see a certain population size of the subject property in terms of the city that the property is in. And that's usually 30,000 or within 50 kilometers of a city or town with 100,000 people. So if you're buying an investment property in a cottage country and there's a very remote amount of people, that's something you definitely want to run by your mortgage agent, your lender beforehand. Make sure that property can be financed because that could potentially cause for an issue. And what you mentioned as well, 3-season versus 4-season, huge implication if it's not a 4-season property. There are limited lenders that will lend on it. It's a completely different type of mortgage altogether. Credit unions are good for those types of properties, local credit unions, but definitely you want to look at the location. You definitely want to look at the condition of the property. You definitely want to look at the age of the property. If it's built more than 100 years ago, it's in a different category, and you're going to potentially experience some issues in getting your financing. Those I would say are the main three: location, age, and condition.
Gotcha. And when we talk about a home appraising, like it's been a big sort of thing the last couple of years, we've seen home prices going up so fast that just about every sale in a neighborhood is almost going to be record breaking. So there's a lot of issues going in unconditional with no condition of financing as protection. What happens if the appraisal comes back lower, and what are the risks involved?
Great question. So it's always a priority for me to be transparent with my clients and advise them of the risk involved in purchasing a property. One of those risks is an appraisal risk. If you purchase a property for $800,000 and the appraisal comes in at $750,000, the bank will only lend on the appraised value. Now, we do have the opportunity to go to a secondary appraiser or a new lender altogether to save the deal. But when you're in the market we're in right now, you should always be prepared to cover a low appraisal. Out of all the mortgages I've done in the past 2 years, I've had only one appraisal that came in lower than market value, lower than the purchase price. And in this particular case, the client was prepared and he had the additional funds and it didn't affect anything. So he was going to make that down payment regardless. So that worked out. But yes, it's always important to have extra money available, especially if you're competing in a very hot market, because no one can guarantee what an appraisal is going to come in at. And by using an excellent realtor like yourself, You're going to be able to have a better idea of the market value of the actual property before you submit the offer. So always consult with your realtor.
And even beyond that, actually in the last 2 years as well, I had one deal that appraised, I mean, my clients, there was 19 offers. They're like, I want to go above. And I said, listen, this is the value. But with every single week, a couple of years ago, this property, boom, 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 it just, you don't know. And the next person's going to pay that, right? Or the next week, it's a new comp and it creates this new benchmark. So my client got the property. They were prepared to finance that even though the appraisal came lower. However, from a real estate standpoint, I went back, I did my due diligence, got some other comps, sent it to the appraiser. So there are other ways that your realtor can help you. And they can go back and kind of dig up new comps to support that price that you first put down on paper. Doesn't always happen, but it is something that you can exercise.
Absolutely, yeah. That reminds me, me and Ryan had a similar situation where our client had a condition of finance, I think it was 3 days if I remember correctly, and the insurer, the lender were on board, they were going to approve it, but they said they weren't so confident in the value, they wanted to send an appraiser, it's going to be about 5 or 10 days. Ryan was quick with his thinking. He sent me, I think, 3 comparables in the area. We escalated the file to the insurer, and in time, we got them to overturn that decision and say there's no need for an appraisal. So as you said, a good mortgage broker or realtor or anyone will go the extra mile for the client and go on every avenue we can in order to find a solution.
A great team, we should say.
A great team, absolutely.
Now, we talked investments on the mortgage side, things that you can leverage, tools, but on the real estate side of things, pre-construction. It's an opportunity to invest in real estate for a specific set of buyers. And I want to know how that will work. Tell us on your end, do you deal with the pre-construction? Do you hold rates? Obviously not for years on end, but how would you go about helping a client who's looking at pre-con?
Absolutely. And pre-construction can be a great opportunity depending on the client situation. So I'm all for it. In terms of qualifying, there's 2 main steps. One is getting pre-approved. You definitely want to make sure you can afford the property before you purchase it, regardless of when the closing date is, because the closing date will eventually come about. If you plan on having an exit strategy like selling or assigning, that's good too, but make sure you figure that out before you purchase. And the second component of the financing is the actual mortgage approval on closing. So it's the same as a mortgage approval for a resale property. You have to qualify. And there's, a couple interesting points when it comes to pre-construction. The price that you're paying, when it comes to closing, the market value is going to be a lot higher, especially if you had a good amount of time between the time you purchased and the time you close. So what a lot of people do shortly after they close on the property is they refinance and take out that new equity and use it for another purpose. So that's one thing. In terms of rates, most banks will only hold a rate on a live deal for 4 months. There are other lenders that go up to 12 months. So depending on when your closing date is and which lender we take to, we can potentially lock in that rate for up to 1 year's time.
Beautiful. Good to know. What about vacant land or land where, because a lot of cottages are being purchased, for example, but land where there's no building. How would you guys go about that?
So to be honest with you, I don't do too much land mortgages, but from what I do know, vacant land, you need 50% down in order to arrange the financing. And depending on what you're looking to do, if you're looking to build on that land, you can get a construction loan for up to 80% of the current land's value. If the construction cost will exceed that amount, then you'll need an ARV loan, which is an after repair value loan, which looks at the value after the project will be done. And then you can have a lender that will lend up to 75% of that after repair value, which is typically going to be more than enough to complete the construction of that property.
Do you know offhand how long that the construction loan can be had for and what an average rate is?
Yes. So it's done in draws. So they definitely want to see that you have the blueprints, the permits, all the renovation costs accounted for. In terms of the length of time, it depends on the project itself. As long as it's consistent with expectations and the project that you're going to be doing, typically between 6 to 18 months, depending on the project, and they give it to you in usually between 2 and 4 draws. as you complete the construction process, they release more and more funds. And then once you're done, you can refinance with an institutional lender for a long-term project. When it comes to rates, you can get this done through the commercial lending side of a Big Five bank, on a lender, if you qualify and you have experience. Otherwise, a lot of people do end up getting money privately, which rates can range between 8 to 12%, depending on the lender and the loan to value.
That's super interesting. And I mentioned in the podcast last week that, buying vacant land and building custom is something I want to do. So, Aubrey, I'm going to be reaching out to you in the future for one of those loans.
Awesome, man.
Now, talking about myself and other real estate agents as well, we're all technically self-employed people, right? So we have different income to what most people would on a salary or an hourly rate at an employer. So what can you say for self-employed people? How do you get qualified differently? And what are the options for self-employed people?
So for self-employed people, it depends on how long you've been in business. For most banks, you're going to need to show at least 2 years of history, and we look at your tax returns. For a lot of self-employed individuals, their net income on their taxes isn't necessarily a true representation of the actual money that they or their business is making. So we have a different product called stated income, where we look at your last 6 months of business bank statements, and we look at your revenues on your bank statements as opposed to your tax returns. So your solution will depend on how long you've been in business, how accurate are your taxes, how large of a property are you looking to buy in terms of the mortgage amount. But I would say the majority of my business owner clients go this stated income route because it's more of a true representation of what they can afford.
And Aubrey, is that also stated income out of a corporation?
Yes, it could be a corporation, a partnership, a sole proprietorship. As long as you have bank statements and a few invoices to correspond with your deposits, that's typically what is used. That can be for realtors, that can be for lawyers, that can be for someone who owns a construction company or a plumbing company. As long as you're self-employed and you have those documents, we can most likely get you approved. The one thing that you need to realize with stated income is you will need 20% down. There are no practical insured products for stated income, whereas if you want to use your tax returns, you can use as little as 5% down, but we will need to use your net income on your taxes.
Gotcha. That's awesome.
Okay, so you've given us a lot of info, super helpful. Now we want to look at and kind of end off here with some forecasting. What do you see coming in 2022? What are your forecasts on rates, the market effects from that, and then finally advice to buyers and sellers?
Okay, so on rates, I do see variable rates increasing over the next 12 to 18 months. How much? It's really hard to say. If I had to estimate, maybe about 1% or so, but like I said, it's hard to say. They will be increasing, though, over the next little while. Bank of Canada has forecasted that, and that will exclusively affect variable rate mortgages. On the fixed side of things, rates have already increased. A year ago or a year and a half, you could have got a 5-year fix for 1.6. Now you can get a 5-year fix for 3%. So the rates have definitely increased on the fixed side. Where they're going, it's tied to the 5-year bond yield in Canada, so I can't really predict that. I would assume they're going to stay around the same, maybe get a little bit higher, but they can fluctuate. I always try not to time anything in terms of rates. Me personally, I'm a fan of variable just because I look over the history of rates in Canada and I know variable has been cheaper. So I stick with that and flexibility. In terms of my suggestions for buyers and sellers, me personally, I'm a fan of holding real estate. I'm not a fan of selling. If you can qualify and access the equity in your home, then I'm a fan of doing that to avoid capital gains, purchase more real estate. It's just a matter of qualifying and having the right mortgage person who can help you understand how to qualify and give you a good strategy if long-term wealth and building a real estate portfolio is your plan. Because no one wants to work the rest of their lives, and real estate is an excellent vehicle to transition into a wealthy lifestyle.
Mic drop on that one. And I think for a lot of people too, it's just kind of like getting educated on the process and the different options that are available to you. There's a lot of people out there that are sitting there thinking, oh, I wish I could buy, but they just haven't done their homework. They haven't talked to the right professionals. They could be sitting on, the perfect qualification for their next home or their investment property, and they just don't know about it.
Absolutely. I've spoken to many clients who had no idea they can buy. They speak to a mortgage agent, myself, or anyone, and then they realize they can, and they're on a completely different path.
Yep. First step is to reach out. So Aubrey, maybe you want to just tell us where someone can reach you at, and then we're going to close this off.
So you can find me on Instagram or TikTok searching Mortgages by Aubrey. You can Google me, Aubrey Borenstein. My contact info will pop up. Feel free to call me or book a call, and happy to discuss your mortgage needs.
Amazing. Aubrey, awesome. Before we really let you go, just promise me one thing.
What's that?
Can you please just go lay in the saltwater ocean and just let me feel those waves and vibes? That's all I want right now. I'm so jealous. We're out here showing properties and you're processing applications with an amazing view, but that's, you're probably leveraging your real estate here in order to do that too. So thanks so much for jumping on here. We really appreciate you.
Thanks for having me, guys. It's been great. And nice to meet you, Danielle. And yeah, thanks again, guys.
Yeah, so thanks again, Aubrey, for coming to the podcast today. It's awesome to get all this amazing information. Guys, if you enjoyed this episode, please like, comment, and subscribe. We're on YouTube, the full video version, otherwise audio on Spotify, Apple Podcasts, and Google Podcasts. So thanks again for coming, guys. Please, if you would like to get in touch with Aubrey, do so. If you want to book a one-on-one with Daniella or myself, you can find the link in the description below. I'm also going to be leaving all of Aubrey's links below so that you can find him easily. So thanks a lot. We'll see you in the next episode. Bye.
Bye, guys.